Okay, so we're going to talk about inventory costing assumptions. All right. Um, and what we're really talking about is the manner in which we move inventory from the balance sheet, the inventory asset account, to the income statement as cost of goods sold expense. All right. So um, let's press on. The most basic method of inventory costing is called specific identification. All right. Specific identification is when every single item in inventory has a distinct cost, and as those items are sold, we take that cost from the inventory account to cost of goods sold. And the visual we have here is, for instance, it tells you we've got cost of goods available for sale, and then it tells you the cost of each unit, the cost of goods sold for each unit sold. Specific identification is useful for large ticket, low volume items like cars or high-end jewelry, all right? Because typically items that have serial numbers, items that are pricey will be specifically identified, all right? Specific identification is not economically feasible for most retail establishments. For instance, Walmart, if they have 100 jars of peanut butter on the shelf, it's first of all, they're not serial numbered, so how would you keep track if they had different costs? Secondly, they may have different costs, but they're likely to be very close, and they're identical in nature. For instance, like specific identification, I said is useful for um, cars. Well, if you're on a dealership, there may be several cars that look similar, but they may have different features and they're going to have different costs, right? So specific identification is a cost flow accounting method. First in, first out, or FIFO, is an inventory costing assumption. GAAP allows for companies to choose to assume that costs flow from the inventory asset account to cost of goods sold in a particular manner. First in, first out assumes that the oldest cost, i.e. the first cost in the inventory asset, are sold first. We're making that assumption even if it's not true. GAAP allows you to do that, to make that assumption. And the recent costs are the last acquired units in inventory make up ending inventory. All right. This is going to be abstract at this point. We're going to get knee deep in this as we talk through. But for the time being, first in, first out means that the first units sold are the oldest, or I should say the first units purchased are the first units to be sold. All right. Last in, first out is the opposite. This assumes that the last item, inventory item purchased, is the first to be sold. All right. Which leaves the oldest cost on the balance sheet in the inventory, in the ending inventory asset account. All right. Now keep in mind, these are costing assumptions. It is very plausible, in fact, likely, that companies can, for example, Kroger, a grocery store, um, Well, grocery stores always try to sell the oldest stuff first, right? You rotate your stock so that you can minimize the cost of stock out. I'm sorry, to minimize the cost of spoilage. Well, in application, Kroger tries to sell the oldest stuff first, but from an accounting perspective, the gap allows them to assume that they sell the most recent purchases first, and that's just what Kroger does. Kroger uses LIFO, right? It is permissible under GAAP to choose an assumption that does not parallel the actual physical flow of goods. So the weighted average inventory costing assumption splits the difference between FIFO and LIFO. So with the weighted average, after each inventory purchase, we compute an average cost, and we use that average cost on a per unit basis to determine cost of goods sold. So this is your formula: your cost of goods available for sale on a particular date, i.e. after each purchase, we would compute this. Units on hand as of the sale date. So we divide cost of goods available for sale by units available for sale after each purchase, right? And again, this may be a bit abstract, but we'll get knee deep in this with an example in class. All right, so each method has its own advantages. FIFO is by far the most widely used, and it is beneficial because, well, ending inventory, i.e. your balance sheet asset account, most closely reflects what it would cost to replace it. All right. LIFO is thought to be income statement focused because cost of goods sold expense is used with the most recent numbers, so it's thought to be a more accurate number. And both of these hold true when prices change. When prices remain constant, there's really no difference between the two. Right? So when prices have changed during the period, this is true. Ending inventory approximates current replacement costs, for instance, or another way of saying the balance sheet inventory asset account is a better number when prices have changed during the period under FIFO. When prices have changed during the period under LIFO, the cost of goods sold on the income statement is a better, more accurate number, right? Because it lines with current cost. Weighted average will always split the difference between the two. Generally, over time, prices increase, all right? Which means companies wanting to minimize income tax liability may choose LIFO for income tax purposes, which is okay, but the IRS says that if you use LIFO for income tax purposes, then you must also use it in the financial statements, right? So there is some tax strategy in choosing LIFO. If we assume prices are going to increase, LIFO is going to provide lower tax liability because your expenses are going to be higher. All right. One of the concepts or the consistency principle under GAAP requires that companies cannot change from FIFO to LIFO to weighted average from one year to the next. Right? There are relatively few instances that justify a change from one inventory costing assumption to the next. The most common being consolidation, where a company using FIFO buys a company that was using LIFO, and so that would justify a change from FIFO to LIFO on the books of one of the companies. Generally, other than that, you can't change from FIFO to LIFO without a justifiable reason.